Hello everyone. In this chapter, we will talk about the stock markets. First, we will look at the market itself, stock markets, where the stocks are traded. Then we will review the fundamental theories about stock valuation. You remember we did last time the stock valuation, how to value the stock. Just we will review this topics, this part. Right. Our key concepts, we will talk about the investing in stocks, buying and selling stocks. We will talk about the indices. Uh, we will talk about the computing the price of stocks and the errors in valuation, right? Also, we'll talk about how the market sets security prices, equilibrium prices, how it's traded. And lastly, we'll talk about the errors in valuation. You remember our valuation is based on the growth expectation or the dividends or free cash flow or the required returns, and we also assume that the growth will be same forever, which is not the usual case. So what are the errors in valuation? What are the problems? In this part we'll talk about it. Right. Okay, as you all know, companies finance their operations by issuing either debt or equity, right? The key differences between the debt and equity is debt is a liability, uh, whereas equity is not, right? Uh, this means that when the company issue a debt, it's an obligation to repay the amounts it borrows, right? So the company has to pay the principal or the face value of debt plus the interest payments on a specific future dates. It's an obligation for the debt. But the equity, it's not an obligation, right? So basically, a share of stocks represents the ownership of a firm. You know it. Investors can earn a return in two ways. The first one is, of course, the dividend payments, right? The stockholder receive the dividends, plus the price of stocks. Investors expect to price of stocks rise over time, right? I'm sorry. Right. Uh, Stockholders have claim on all assets. Okay, I have a questions. We said that stocks are more riskier than bonds. Why? Why do you think it's more riskier than bonds? Yes, anything. Default risk. Yes, default risk, but uh, what else? Right, default risk, of course. That's it. This is the main reason, Leila. You're right. Because the dividends are paid after the debts are paid, right? Because the stockholders have lower priorities than bondholders, right? Uh, Plus, of course, dividends are less certain. We don't know next what will happen to next year, right? Plus, the stock prices, we cannot guarantee the stock prices will increase in the near future. We don't know about the stock price. It may go down as well, right? So it's more riskier. Nothing is certain. Then, of course, the return should be more high, more, right? So that's why stocks are more riskier. Plus, of course, means that more return. Uh, Well, one more thing, of course, the stock owners have right to vote for the directors and on certain issues, right? Assume that they can okay, right. Anyway, let's move on to the next slide. Basically, we have two types of stock, which is the common stock and the preferred stock, right? Common stock is an ordinary stock. It has right to vote. Sorry. Of course, the common stock owners have right to vote for a top management or some important issues related with the company, and they receive dividends based on the company's performance, right? This common stock can be callable or puttable. Callable shares gives right the issue. Well, let me explain like this. The issuing company have right, not obligation, but right, okay, to buy back the shares from the investor at a predetermined level, price level. So if it is callable share, you know that this share will be called in any time or on a specific time. It's predetermined time with a predetermined price level, right? So the company has right to buy back these shares. Okay, it's not an obligation; it's right. The company have this right. If it is puttable, now this time investor have right to sell these shares to the company, right? So at the predetermined price, at the predetermined time period, the investors can sell these shares or have right to sell. It's not an obligation again, it's right. Have right to sell these shares to the company if it is puttable. Is it clear the callable and puttable shares, the meaning? Any questions? If you have questions, please ask. I'm waiting for your response. The call or put price time is predetermined, right? You know it. Time might be the open-ended. I mean, starting from next year, the company may call it, right? So until when, it might be any time. But anyway, you know it. It's predetermined, and if it is forever, again, you know it. I guess the callable and puttable, at least the definition is clear. Right. We have preferred share as well, right? Uh, Preferred share it has the characteristics of both debt security and the common shares. So unlike, well, of course it receives dividend, but this dividend is fixed, right? So if you have a preferred stock, you know that you will receive a fixed dividend no matter what happened to the profit of the company. Maybe the company is very profitable, the dividends are very high, but you will receive a fixed amount of dividend, right? But it's unlike the interest payments, it's not an obligation. If the company is not profitable for that period, for that year, then they will not pay you anything else. Might be the case, right? If it is profitable, then you will receive your dividends. So it's between bonds and common share, right? This preferred stocks also can be callable or puttable again. And also, additionally, this can be convertible as well. This preferred stock can be converted to the common stock with a conversion ratio, of course, right? So this conversion ratio is again period-determined. When it's issued, it's if it is convertible preferred stock, then you know it, this conversion ratio. Let's say two preferred stocks can be converted to the one common stock, right? So you know it. You can convert it on a specific date, of course. So you know this conversion ratio, you know this uh, time frame, if you want to convert it, right? So common stocks cannot be converted to the preferred stocks, but the opposites, preferred stocks, can be convertible to the common stocks. Clear from this start, this part? Any question? Yes, Salgun, thank you very much. Any other response, any question? Yes, there is a question. Is there a case in both common and preferred stocks that dividends are paid only when the company is profitable? Of course, for the common stock, yes. I mean, if the company is profitable, if there is any profit, then the company pays dividend. Same for the preferred stock as well, right? Right. Paying a dividend is not an obligation, fixed dividend, right? If the company is profitable, then the preferred stock owner will receive the fixed dividend. If not, nothing. Okay. Good. Let's move on to the next slide. Okay. How stocks are sold? Right. Stocks are traded in both organized exchange markets like Baku Stock Exchange, Istanbul Stock Exchange, New York Stock Exchange, or over-the-counter market, OTC market. Let's talk about the organized market first, then I'll explain the OTC market as well, right? Uh, Organized markets like Baku Stock Exchange, they have a specific location, right? So you know it, all the trades are, all the deals are, or everything is on a specific locations, right? Of course, in this specific locations, only the listed companies are traded. Uh, for Istanbul Stock Exchange, only the listed stock exchange companies are traded in Istanbul Stock Exchange, not all of them. Same for the Baku, same for the New York Stock Exchange. So all the organized markets have their own listing requirements, right? Order types, of course, your orders can be either buy or sell orders. Okay, you can buy any stocks or sell your own stocks in this markets. We have two types of order. One is the limit order, the other one is the market order. The difference, okay, there's a question. I'm guessing we have our pop quiz after the midterm assignments. Nigar, we will talk about this midterm and pop quiz. I will explain after the class, right? Let me finish this part. I will explain it. Don't worry. Okay, we have two types of orders, limit order and the market order. The difference is in limit order, right? The quantity and the price must be indicated at the submission. Let's assume that you would like to buy a, let's say, Turkish Airlines stock, right? At the submission, at the very beginning, assume that I don't know the price level of Turkish Airlines right now, but assume that it's traded at, let's say, 10 Turkish lira for one stock. Okay, so you are submitting with the price of 10. You want to buy, let's say, 10 stocks. At the beginning, both quantity 10 stocks and the price 10 Turkish lira indicated. Okay, so you can only buy with the price of 10. If the price goes up to 10.5, 11, 12, whatever it is, you don't want it. Just you are ready to buy with the price of 10. And the amount should be 10 stocks. That's it, right? So if it is limit order, both quantity and the price, both are indicated. Okay. If it is market order, just the quantity, not the price. You are not concentrate on the price level. Just you are indicated the quantity. You want to buy, let's say, 10 shares. That's it. Whatever price is, 10, 11, 11.5, 12, whatever it is, just you would like to buy it, right? Or might be a sell order. Again, everything is the same for the sell side as well. Just you want to sell it with any price. Right now, you see the whole stocks in all around the world is go down, right? So everyone try to sell their shares without checking the price level. Just want to sell it, right? So these are the market orders. If they want to sell in a specific price level, then this is a limit order. Is it clear the difference between the limit order and market order? Thank you, Nazrin. Any others? Any question? I guess it's clear. Okay. Uh, all submitted orders, all submitted limit order, of course, limit orders, not the market orders, but limit orders case, are valid until the end of the trading day. Okay, there's a question. The price and the quantity are indicated by possible stockholders as a request or by no. Of course, the stockholder, I mean, the investors, not the company. It's not an IPO. It's secondary markets, right? So the price is determined by the supply and demand force. It's not related with the company. Company is sold in IPO with a specific at some price level, so that's it. It's gone. Right. Uh, all the, as I told you, all the orders. Okay, there is another question, I guess. For example, we want limit order. Okay. Before submission, the price of the share Turkish Airlines is $10. Okay. However, we indicate the price of $8. Okay. So when the price of shares drop to 8, we will buy automatically. Number of, yes, you will buy the automatically how many shares, let's say 10 shares. You indicate the amount, the quantity as well at the submission, right? So from the price of $8, you will have, let's say, 10 shares, right? So this shares, this orders, your limit orders, are valid until the end of the trading day, right? So it's you indicated the price, you submit the price of 8 and wait until it will drop down to 8, right? Definitely. Uh, this mechanism, how this trading done during the day. Of course, continuous tradings match orders based on the best execution price principle, right? So what's best execution price? I will explain in the following slides. If it is not the best price on buy side or in sell side, you are in the trading book, order book, and wait until the end of the trading session, right? Again, all submitted and non-executed orders are wait until the end of trading session, right? Well, the trading session in Istanbul, I don't remember, but I'm not sure. If I'm not mistaken, starting from 8:30 to 5. It was something like that. So it's not a 24-hour trading, so you have the end of trading time, right? All the tradings are like an auction tradings, right? So you know that how the auction works. Someone, if let's say want to buy any item, then the next one, that the other one is increasing the price to have these items. So until the best price at that point is the highest price, right? Same for the market as well. I will explain how this auction tradings occur in the markets. Okay, so we have two main principles of matching. The first one is the price priority. Second one is the time priority. What's price priority? For the buy side, let's say the highest price is the best one. I mean, you want to buy the, let's say, Turkish Airlines with $8 or 8 Turkish lira, let's say, right? And someone want to buy it with the price of 9. So then this price 9 is better than you. So 9 has the priority. That price, the new order has the priority because of the price is higher in buy side. Same for the sell side as well, right? If the price is lower, then it has a priority in the sell side. Okay. Okay. What if the both prices are same? If someone is submit the price of 8, what happened? Then we'll check the time, right? Time priority. If the both prices are the same, then the price are executed by the time priority, right? Is it clear, this price and time priority cases? Any questions? I'm waiting for your response. Clear, clear. Thank you very much. No question. Great. Thank you. Could you please give an example of time priority? Yes, I mean, you remember our $8 Turkish Airlines example. So someone wants to buy at that price again, $8, right? After our order, then we will be the first one. If the price drop down to 8, we will receive first, before them, before the other guys, right? Because we were, yes, okay, clear, good, right. So okay, what's the best price? But as I told you, orders are matching by this best price algorithm, right? When the new order is submitted, this system checked with the best price. So the best price is the highest price among the buy orders, right? and the lowest price among the sell orders, right? Of course, if you want to buy anything else, anything, the highest will be executed first. If you want to sell your assets, the lowest will be executed first, right? It's clear. Any question? No, good. Okay, so we have an so I'll give you an example, but before the example, let's see this. Let's cover this slide. A new buy limit order is matched with the sell order if the sell order price is equal or lower than the buy order, right? So if you enter a new limit order means price and the quantity both, right? You submit the both, okay? This order will be executed if it is equal to the sell order or your buying price is higher than that sell price, you will get it. Same for the sell side as well. Let me give you an example for the buy side and sell side. Hope it will be more clear with an example. Assume that, forget about this buy side 981. Forget about it. Assume that we don't have it right now, right? We have sell side only. And we have three price level with, let's say, the quantity of 1. Each has the quantity of 1. The lowest one is the 915, second is the 920, and the last one is the 985, right? These are the orders, limit orders submitted in the markets. So they are in the, and nothing in the buy side. They are waiting in the sell side, in the order book, right? So we are submitting a new buy order, limit buy order, right, at the price of 981. Of course, when we submit this 981, automatically this is executed by 950, the price level of 950, right? Because, I mean, we are ready to buy with the 981, but in the market, someone is already selling with a lower price. Of course, this system executed at the lower price. Any question? Is it clear? Good, great. Thank you very much, guys. Okay, let's see the sell side order. So we have two different cases in sell side. Okay, good question. After match, the actual price paid will be 950 or 981. Of course, it will be 950 because someone is already in the market with and ready to sell with the 950. So this sell side is already order book. When we want to buy it, it's automatically executed at the lower price, 950. So the market price will be 950, not 981. Right? The executed price will be the market price at that second. Is it clear, Nulan? Good, thank you very much. Let's see the sell side example. Again, assume that we don't have sell order, we only have the buy side, right? Starting from 10.01, we have four orders, 985, 970, 8.5. So these are the buy side in the order book. It's already in the markets, right? Someone is ready to buy with that prices, right? Assume the quantities are all 1. a new sell limit order is submitted with the 10.15 price, which is it's a limit order, right? So at the submission, the price level and the quantity both are given, right? So we are ready to sell it with the 10.15 ASEAN, but not lower than it, right? Then, of course, there will be no execution because the buying price is lower than our price, and we don't want to sell it with a low price. So both orders or all orders will be in the order book. So the market is waiting, no execution, nothing, just wait for someone else to buy our orders or sell to someone's bid, right? Is it clear, this sell side example? Okay, good. Let's check the another sell side example together, right? Again, assume that this 10.15 is not in the market, right? But this time in the market, we have 10.20, 10.15, 9.70, and 8.5. These are, it's already in markets. It's already in order book. These are the limit orders, right? So a new sell order is submitted with the price of 10.15. We are ready to sell it with the price of 10.15, but luckily someone is ready to buy with 10.20, which is higher than our limit, right? So if it is the case, when we submit our order 10.15, price and the quantity is one, we are submitting the both price and quantity. When we submit this order will be executed at 10.20 because in the buy side there is a higher price. 10.20 is already or in order book, right? So the execution price will be 10.20, not 10.15, because we have a higher price in the buy side. Clear question? Thank you very much. Good. Okay, let's move on to the OTC, over-the-counter markets. Right. The best example is the Nasdaq for the over-the-counter markets. National Association of Security Dealers Automated Quotation System. So it's the Nasdaq, the full name of the Nasdaq, right? In this markets, dealers itself provide the bid and offer prices in the market, right? And the investors can choose the best bid or best offer price. So we don't have an organized markets. So every dealer in this market, every bank, let's say, provide their own bid and offer prices, bid and ask prices, or both prices they quoted in the screen, so all investors can see these prices, right? Assume that you have seen the best ask prices and you would like to buy it, then call this dealer and buy it separately, so no one knows what's going on in the markets, right? So no one has an idea about the quantity traded in the markets, in the OTC market. But of course, in the organized markets, it's this information is publicly available. It's open to everyone. So this is, I mean, this market is for two counterparties. in Turkey, we don't have the OTC stock markets, but usually in bonds are traded in OTC markets. Right. Any questions from this OTC part? I guess that's clear. What's the differences? Well, in organized markets, uh, sometimes it has a floor specialist. So you cannot submit your order by yourself. You have to submit your order to the specialist. And this specialist, floor specialist, is submitted to the order book, right? The best example is the New York Stock Exchange. Once upon a before 1994, if I'm not mistaken, Istanbul Stock Exchange was like that. Then they have changed the Istanbul Stock Exchange. Right now, it's everything is submitted electronically, so you don't need the specialist to do it, right? Uh, in OTC markets, there are multiple market makers. They are sending their bids and ask prices, right? So we can see multiple dealers for multiple securities, right? Of course, everything is done by electronically. Yes, I mean, in New York Stock Exchange, still they have a floor specialist, and you submit your order to the specialist, and the specialist is ordered to the order book. That's it. I mean, you cannot do it by yourself. You need someone else, right? Uh, yeah, but these days everything is traded electronically. Do we need the floor specialist? I think we don't. But anyway, they like it. Okay. Uh, Exchange traded funds are the recent innovations. Uh, it it helps to keep transaction costs down, right? And also it offers the diversification. Uh, ETF for the last, let's say, 30 years, it's became much more popular, right? It's a kind of uh, basket of securities, right? So it's let's say indexed to a specific portfolio. So it's copying, let's say, the Istanbul Stock Exchange index or the S&P 500 index. It's copying that index. So the fund manager do not need to manage anything else. Just copy the index, right? So you know the weight of each securities. So based on this weight, just copying the index. That's it. So if it is the case, uh, everyone, both investors and the fund managers, can easily calculate the value, right? So there is a very, I mean, the price differences of this ETF and the index are is not significant. I mean, it's almost the same price. So you know it, your portfolio, if you're investors, your ETF will increase the same as the index itself because just it's copying the index, right? As an individual investors, you cannot copy the index by yourself because you need to buy 100 different stocks at least. In S&P 500 you need to buy more stocks, so you cannot do it by yourself. But if someone, if the ETF, if the fund manager do it and sell it one share to you, then it's now for you, for individual investors, it's now you can do it, you can buy it, right? So that's why. And also you don't need to worry about the specific stocks. uh, you don't need to worry about the default risk, right? These are not your problems anymore. You are just concentrating on the return on index. So that's it. So that's why it's became popular over time. Okay, let's move on to the right. Do you remember from the previous classes, we can find the value of a common stock just by discounting the dividends, cash flow, right? Or if it is not possible to discount the cash flow of dividends, we discount the company's free cash flow, right, to the present value. So the value of this company is equal to the discounted all present future dividend payments, right? So this is the dividend model. We already covered it, but the only difference is instead of RE as a notation, this book, the Mishkin's book, use KE as a required return, right? So both are the same. You are discounting the dividend by the required return of the investors, and you add them all. This Gordon growth model is end up with this formula, right? D1, the next year dividends, divided by with the required rate of return minus growth rate, right? Of course, in this model, we assume that the growth rate is a constant. We assume that the dividends is increased with a G percentage over time, right? And of course, the required return is constant as well. Our notation was RE, but here use KE, it doesn't matter, right? Right. As you all remember, this model is useful with a constant growth rate. We assume that the growth will be constant forever, which sounds unrealistic, but this model assumes this is the basic assumption. And the other assumption is your required return should be higher than the growth rate, right? Otherwise, the model is not working, right? You need to do it separately. So based on this two assumption, we can calculate the price of any stocks, right? Okay, let's move on to the next slides. Here is the basic example from your book, right? Find the current market price of Coca-Cola, assuming the dividends growth at a constant rate of 10.95%. Dividend right now is $1, and the required return for this stock is 13%, right? How do we calculate the price? First, we need to calculate the next year dividend, D1, which is the 10.95% more than this year. So in this case, of course, the dividends is right 1.1095. Okay, and we need to divide this required return minus G rate. So the required return is the 13%, G is the 10.95, right? So we divide it by 2.05. So the price of this stock is 54.12, right? Basic calculation. So we did it with this constant required constant growth rate model. Okay, the other method, if you cannot find the dividends or the company is not paying dividends, you can calculate based on the free cash flow model, you remember, but in this time, instead of required return, you need to discount it with weighted average cost of capital, right? So this is the second model. And the third one is the ratio, right? If you know the price to earning ratio or sales to earning ratio or other ratio, then of course I'm talking about the market average or the industry average, then you can you can estimate the price level for that specific targeted company, right? As an example, here is a basic example in the next slide. Uh, Assume that the industry average is the price earning average is the 16, and you know that your targeted company's earning is 1.13 per share, then your targeted company price should be something around $18, right? Based on this earnings, so the price should be around $18. This is widely used in the stock valuation in the markets, right? So what does price earning means? Uh, Means that, let's say the price earning ratio is 16, means that investor is willing to pay $16 for a $1 current earnings, right? For $1 earnings, investors is willing to pay $16. So this is the interpretation of this ratio. Any question on this part? Okay, good. Let's okay. What's the PE ratio? Let's say in this example, 16 is our PE ratio. What does 16 indicate? It means that for $1 of earnings, investors are paying $16, right? They are ready to pay $16 for $1 earnings, right? Thank you. So this one is the easiest one, I guess, out of this three model. What are the problems in valuing the company stocks? Of course, as you all know, we try to estimate the growth rate, and we assume that this growth rate will be constant, which sounds unrealistic. And also required return. We assume that this required return is constant over time, right? So this is the second problem. And the third problem is you try to forecast the dividends, which is, again, I mean, it's not easy. It's not possible to assume the dividends will grow in a constant rate forever. It's unrealistic, basically. So if you change any of these, let's say required return is changed, let's say 1%, then there will be a huge differences between the price levels. I mean, with changing just 1% in the required return makes a huge differences in price level. So this model is, well, everything is based on the assumption. So you can easily manipulate the value, right? So this is the main problems with this model, basically. But uh, as a general idea, I mean, it gives an idea about it. It gives an general feelings. Let's check the 2008 financial crisis, right? Uh, think about it's exactly the same as right now. Think about the growth rate. In 2008, uh, because of the mortgage crisis, nobody is expecting the high growth rate, G, right? Same as right now. Are you expecting a high growth rate, high G right now? No. That's why uh, I mean the price of stocks goes down, right? Plus, because of the uncertainty, the investors require high return, right? High, it's shown as KE, and in our notations RE. We are the investors require high return. Then, of course, it's again lower the prices once again, right? So yes, this model is not an to calculate the value of stock, but it gives them general idea about if the growth rate is go down, if the required rate is go up, the we end up with a low price level. So that's why right now, and it was same as the 2008. Right now, the index level, the value of stocks dropped down. Right. Uh, let's talk about any questions up to now. Anything? Any questions? No. Okay, thank you very much. Let's move on. Well, stock market indices. Why do we need stock market indices? Because uh, it's a well, we can understand the behavior of group of stocks with the indices. If the indices goes down, then we know that the majority of the stocks goes down. Of course, there might be some outliers, of them may go up, all the stocks goes down, might be the case. But in general, you have an idea that the group of stocks going down, right? So it gives an idea about the markets, like Istanbul Stock Exchange Index or S&P 500. Unfortunately, I couldn't find the Baku Stock Exchange Index. Uh, Probably there is, but I couldn't find, right? So it's a general idea. It gives a general idea about it, right? Uh, as I told you before, the index, I mean, investing in stocks is more profitable comparing to investing in bonds because it's riskier, and based on this risk, the return should be more higher, of course. Assume that if you invest $1 in 1980s, at 40 years, let's say in this 33 years ago, when based on this example, if you invest $1, right, your return, the annual return, should be 8.8%, right? How do we calculate this one? So we assume that at the beginning of 1980 it's $1, right? End of 2012 we have 33 years, because 32 plus beginning of 1980, 33 years, right? So our return should be, how do we calculate our return? We know that the index end of 2012 is 104, should be equal to 801 plus return over 33 years. Right. So this should be the return. This return should be 8.8%. Around this 33 should be the over 33. I couldn't write the over, so it's think about 1 plus return, which is 8.8%, right, over 33 years. Why it's 33? Because once again, because the index was in 800 at the beginning of 1980s, right? So, as you have seen, investing in stock is always better than investing in bonds in the long run, of course. Any questions up to now, guys? Okay, there is one from the Nurlan. If they go down, indices go down, means that the general value of stocks will go down. Yes, definitely. It gives an idea about the markets. It gives an idea about the majority, right? Okay, thank you.